Good afternoon, everybody. I hope you've all enjoyed your tea and cake and are back ready for our next session of today. For the next half an hour or so, we're going to be discussing the issue of sustainable infrastructure investment. The amount of capital required to get to net zero is immense. And so I hope today we can get an idea of what the right sort of projects are to do that, now and in the future, what those projects might be, how to evaluate them, and in some, we'll look at how to attract investment to the right sort of infrastructure by matching capital with appropriate projects. And to get to the bottom of this, I have three guests today who I'd like to introduce you to. We have Jane Stevensen, Founding Director of JS Global Advisory. At the far end, Bill Rogers, Managing Director, Head of Sustainable Energies, Europe and Asia for CPP Investments, and Nuwan Goonetilleke, Head of Shareholder Assets at Phoenix Asset Management. I suppose the big question is, what are the right sort of projects? But Bill, perhaps you could sort of set the scene for us and sort of describe what exactly we mean by sustainable infrastructure investment.
Yeah, thank you, Simon. I guess sustainability is obviously an important topic for someone like CPP. For those that don't know CPP, we're the Canadian pension plan, so we're investing for 21 million Canadian beneficiaries from currently a pool of about $550 billion. And so we're investing for 30, 40, 50, 60 years. And so understanding what's going to happen in terms of climate change, the impact and the risks and opportunities that makes our investments, is something we look at actually in all of our investments, be they public equities, public debt, private equity, or private debt. In the real assets team, which I sit in, it's about a $100 billion portfolio, and we own and invest in infrastructure for the long term. So we have our real estate colleagues who own buildings around the world. We have our kind of infrastructure colleagues who own essential utilities such as water and roads and other assets, and then my sustainable energies team. Sustainability fits in what all of us does. So, if I think about my colleagues in real estate and in infrastructure, as they're making investments, understanding what climate change is going to do to that investment. Is it going to lead to increased road usage or less road usage? What's it going to mean for the buildings they invest in? And then how they manage those assets to make sure that they're managing the risks around climate change and taking advantage of opportunities. So our real estate colleagues are very focused on making sure that their buildings are as green as possible. That's to make sure that it manages the risk, but also they see great value. More and more renters of buildings are willing to pay a premium for green buildings, and so that we're investing behind taking the building stock that we own and making it greener. Similarly for my infrastructure colleagues. So we are an investor in Anglia Water here in the UK. They have a 2030 net zero plan where they're making their operations as efficient as possible by putting pumps, retrofitting water pumps to make them more efficient. They're putting renewables on their site. They're buying green power. They're using the biogas. So, in our traditional real assets, real estate and infrastructure building business, sustainability is a core thing of what we look at when we're making investments and we're managing investments. I guess in our sustainable energies business, we set that up 5 years ago to target exactly what I think we're talking about today, which is the new type of infrastructure or retrofit of infrastructure where we're looking to deliver against the energy transition requirement or the 1.5 degree aligned requirements. And there we're looking at kind of three types of investments, at least how we think about them. We got a very broad mandate, so we can talk a bit about how the infrastructure is set up. But I'd say you've got our traditional infrastructure investment, which tends to be investing in proven technologies where the economics make sense, and you've got kind of long-term visibility of the value of those assets. So, in the sustainability sector, in our group, that would be investing in renewables. So developing wind and solar projects and battery projects where the economics make sense and it's just about rolling them out at scale. We're then looking at kind of projects where the technologies are proven, but the risk-adjusted return don't yet make sense for your traditional lower risk, lower return infrastructure investor. So there it's maybe battery storage in certain markets where the revenues that you get are uncertain. Hydrogen and the development of hydrogen infrastructure, or carbon capture utilization and storage. So there it's about trying to invest into companies where they're working in partnership with the off-takers, corporates that want their product, or governments that want those technologies to develop, to make and scale those businesses so that the investment makes sense for larger volumes of investment. And then lastly is looking at new technologies that would go into infrastructure in the future that maybe don't yet even work. So long duration storage, some of the new chemicals, and thinking about decarbonizing cement. So we put a 20 million investment in a company called Solidia that does new types of cement that reduces the carbon intensity of the cement production process. But then also, as that turns into concrete, it does it with absorption of CO2. So ending a larger volume of the concrete that is produced actually is CO2. So therefore embedding that in those and sequestering that for the long duration.
You talked about evaluating these projects, and I think that's the sort of nub of the matter. But before we get there, Nuwan, your company has been involved in a project looking at the vast sums of money that are actually involved here, and that's why it's very important that we're able to evaluate these. Perhaps you could talk us through, that and give us a sort of sense of how much money needs to be invested in all of those projects.
Yeah, sure. So as part of Phoenix Group, we have 310 billion of assets under administration now as part of the sort of specific shareholder assets portfolio. We are an investor for the long term on a very similar basis to the Canadian Pension Fund. Where I think we obviously differ, we are a Solvency II regulated firm. So, the criteria for investment, we're towards the lower end of return and risk, I think as Bill sort of classified it, which makes the sort of infrastructure space really very attractive for us, when we're looking to invest for those 30, 40, 50, 60 year type durations. Now, along with the ABI, I think we conducted a study that said the net zero trajectory will take about 2.7 trillion. And of that, about 1.5 would be in the sort of longer dated sort of debt funding space, which insurers could be part of. But that clearly still leaves 1.2 trillion that's required to be found in sort of less proven or even unproven technologies, which will need to come through either equity or equity and loan financing. These are really huge sums that will need to come predominantly from the private sector, it feels like, at the sort of this stage in the cycle.
That's great. There were huge sums of money involved. These projects are risky, some of them are uncertain. Jane, how do you see, going forward, how you evaluate whether these projects do what they say they're going to on the tin, delivering sustainability, getting to net zero? Could you give us a sense of how you think we should go about that and what's going wrong, if it is, with the current system?
Yes, well, I sat here today and listened to telephone numbers of investment going into green projects, and we've just heard more huge amounts of money sloshing around the world, which are all being funneled into the right projects. But looking at real activity in the real world, seeing projects that appear to be green initially, but at some point on their journey to fruition, to the final product on the ground, have flipped into something that is completely opposite to that. And I think what I'd like to find out from the two experts I'm sitting on a panel with who come from that infrastructure knowledge base is, first of all, how is that happening and why is that happening? And how can we actually use what we've already got to create a really powerful lens to look at, to assess projects through before it's too late, before they become something that should be green, but actually in reality is anything but. And I think I'd like to sort of bring a real example into the discussion. If you have a project which starts off as creating renewable energy, offshore, fantastic, new wind farm, masses of investment going into it, 100% green, would tick every box. But as it hits onshore, it suddenly becomes something that really isn't that. And I think I'd like to frame that through the viewpoint of the EU Taxonomy, which we've heard referred to earlier in the day. breaking it down to a very, very simplistic viewpoint, it gives you a way of assessing, a set of criteria to look at an investment into a project to figure out, is it green or isn't it green? And there are six criteria which give you a box to tick. I mean, I can read them out to you. I don't remember them off by heart, but I've got them here. So if they do any of the following: climate change mitigation, climate change adaptation, sustainable use and protection of water and marine resources, transition to a circular economy, pollution prevention and control, protection and restoration of biodiversity and ecosystems. Pretty clear. That's it. If you can tick one or more of these boxes, surely we're fine. But there's something else that goes with it. Underpinning that is a requirement that whichever box you tick, your activity also must not do any significant harm to the other criteria in the list. So think of my example of the offshore wind farm. It hits land and immediately goes through an area of outstanding natural beauty, 3 sites of special scientific interest, destroys vast amounts of very fragile ecosystem, eats up hectares, hundreds of hectares of rural land, which actually, by the way, is acting as a sequestration point, which is enabling, or is part of the enabling function to get us to net zero anyway. So that's really my question, which I'd sort of like to sort of throw out to my 2 fellow panelists, is what lens do you look through to actually make those decisions? And supplementary question, if something is beginning to be a real project in the real economy, but it becomes very clear and is actually screaming at you, hang on a minute, everybody, this is going horribly wrong. It's flipping from a green project to anything but that. Are there any factors that we can use? Are there any safety nets that you as investors or infrastructure providers can actually deploy to, in the end, result in a green project?
Bill, is that reasonable criticism? Is the lens strong enough?
I guess I don't know the specific project you're talking about, Jane, so I can't comment on that. But I guess maybe kind of two or three things to talk about. I mean, firstly, when you think about what we're trying to do here in terms of the build out of new infrastructure, the problem is vast, right? If we look at the amount of renewables being built out today and look at the forecast of what's needed, you need to increase by 5 to 10 times per year the volume that you're producing. So how do you do that, yet have all the right checks and balances in place to make sure that these new projects are being rolled out without damaging the environment, with having the supply chains that themselves are emitting at the right level? As you think about longer supply chains, thinking about other issues that come into those supply chains, where is the cobalt coming from in the EV? Where is the polysilicon coming from in your solar panels? So I think there is a real challenge for the industry, which is we know that we need to develop these projects, but how do you do that in a sustainable way themselves? So when we're looking at every new project, we're doing our own independent due diligence on some of those broader ESG issues, understanding the supply chain, understanding the impact on the natural environment, looking at some of the biodiversity impacts you have. And I guess the checks and balances we have is, at the end of the day, we don't need to invest in that project. Doesn't mean someone else won't invest it, but at least from our side, it means that we don't need to invest it. And so we're not using our capital to build those projects that are being more damaging than positive. But how do you do that more broadly? How do you get the right planning system in place in a country? How do you get the right checks and balances in a country that you can get the scale up of the deployment of this infrastructure, but make sure it's not having more damage than it is having positive benefit?
Yes. So I'd echo lots of those comments. Obviously, the initial lens is very much through the sort of project of that infrastructure, and I think that's a very sort of traditional finance lens to look at this in. Being able to go that sort of step beyond into looking at the wider impacts on the end-to-end basis. This is still very nascent work, if you like, and the data is still very difficult, I would say, to uncover on a full end-to-end basis. And as we go through time, taxonomy may change, projects as they go through their sort of either construction or onlining phase, will often, potentially have different characteristics to where we started. So I think we're still learning on that journey. Very similar to Bill's comments, that if we get to a point where we can see, that project is going to be doing some harm at a point, then we will simply not invest at the stage that we can. But I think our starting point is still very much based around that sort of project infrastructure view. But as we go through this, then I think we're provided more and more data to understand how we do those checks and balances. How do we work with government to know that the end to end is better accounted for. But also I think a lot of the codes are still voluntary as well. So I think a certain harmonisation would also really aid being able to monitor that on an ongoing basis.
I'm still slightly confused here. What is the answer then? I mean, who should be stepping in here to set these standards? Well, is it...
So for us as an investor, we set our own standards.
Yeah.
So we'll make sure we're doing due diligence to make sure that project does not have issues in what we term the broader sustainability. But I think that's not enough, right? What we're talking about is how do we deliver the new infrastructure required while in a sustainable way? And that requires government action. That requires regulators and the planning process to put the right checks and balances and processes in place. But it is trade-offs.
Yeah.
Having developed a number of offshore wind farms and other wind farms, there are potential impacts on bird migratory routes. And wherever you put them, there is going to be some impact. How do you manage that? You can do visual warnings, you can have curtailment, so in certain periods of the year you have it less. But there's a risk that there will be impact to birds. Yeah. And so there are trade-offs here, and that's the debate you need to have, and you need to make sure that that's transparent debate, and you need to make sure that the processes to verify and check out are kind of rigorous. But that, I think, is what needs to happen in the broader industry.
And Jane, how do you think we should handle these trade-offs?
Well, I think the point about planning is really important, and we were saying in our chat before coming up here that it's a real shame we didn't actually have a planner as part of our discussion, because actually it's so critical in terms of developing infrastructure projects and making them appropriate for where they're planned. And I think another element of this, which again it's a huge sort of elephant in the room, is what do we do with the old stuff? Because we are talking about all the new infrastructure, and actually I'm really pleased you referred to the cement issue. What we really don't need is to cement half the country, because cement itself is such a problem. But we've got an awful lot of old infrastructure. Do we just build a whole new set alongside it? Because we see all these brownfield sites, but they're not doing anything. They're just sort of sitting there. And I think that appears to be a huge problem in understanding. First of all, I presume we need a lot more investment to take those old sites down in whatever way we decommission them. I know a bit about the oil and gas sector, so decommissioning oil rigs is something I'm very familiar with. But, old brownfield sites which are just sitting in various parts of the country seem to continue to sit there while we build new infrastructure. And I'd love to understand a little bit more about how we are going to square that circle.
And that's a real risk, right? If you look at the way that the net zero debate is happening, you get this kind of divest movement, and you get kind of institutions locking into, I've got to be net zero by this date, and I therefore need to step away from all of these traditional assets. And the result is those just end up in the hands of investors who are less focused on sustainability, and they're not managed efficiently, and they're not transitioned to assets that can become sustainable. So from our side, we've committed to trying to being net zero before 2050. But we've given ourselves the flexibility to be able to use our capital and the expertise of us and our partners to invest in traditional assets and transition them. And we need to do that when we've got an independently verified route to transition and accelerate the decarbonisation of those assets. But without that, we're worried that those assets are going to become stranded. And that's bad for capital, that's bad for kind of impact on the environment. It's also bad for knowledge. So actually, we have a portfolio company that is a traditional energy portfolio company that does midstream gas assets. So it transitions gas from one place to the other. And this is a legacy asset from our portfolio. What we found is working with that management team who know how to develop and run gas assets, they are perfectly positioned to build carbon capture and transition storage assets. And so we've built one of the first CCS trunk lines up in Alberta in Canada that takes carbon dioxide from a hydrogen plant and then transitions that across and sequesters it in oil wells. And we couldn't have done that without the knowledge of that team. So it's partly the assets, but it's partly the knowledge and capability and skill sets that you have sitting in these companies that if you just divest and leave them to run off those assets, you lose in terms of bringing that knowledge into what we need, which is to use the traditional energy access and knowledge to be able to deliver new energy assets.
Nuwan, sorry, you want to come in there?
Yeah, no, so I think we've got a very similar policy in terms of net zero and committed by 2050 or before. And again, we have left some space for those sort of transition assets. I think our primary method we've stated has been engagement, both with management companies and with, any of the sort of public companies we invest in to see if we can assist in that process, because, they're often the largest spenders of capex as well in some of the sort of sectors. So actually, by excluding investment within those companies and those sectors, we're probably actually having the adverse effect from the overall goal we're really seeking here. In terms of sort of taking that a step forward, there's clearly some work to be done depending on where do you draw the line. So you were not getting the engagement when we're not getting the change that we needed to see. But ultimately, I think at the moment, there's very much a clear steer from all of the companies we engage with, to really pick up this topic and sort of take it forward. So I think we are seeing movements in management. We are seeing the changes in policy to suggest that that capex is being well spent. And I think, as Bill pointed to, the knowledge drain potentially by not supporting these companies who have the capex budgets because they have the existing free cash flow to be able to support the build out of what is effectively equity funding, essentially. Especially these unproven technologies, becomes markedly more difficult if we then starve them of capital.
Maybe just one more point, Simon, okay with you. I think the other really important thing here is transparency, which is trying to encourage companies, and Jane, you'll know this from your previous work, to be able to give transparency to investors around their transition pathways. So for them to transition to net zero, we try and encourage them to think about it in three ways and actually to report on this. One is with technologies that are available today and the cost benefit of those technologies, how much of your carbon emissions can you decarbonize just through rolling out those technologies? Secondly, is you look at kind of technologies today and their cost, but you have a carbon price of, we asked kind of at $75 per tonne and $150 per tonne. What additional decarbonization could you achieve with that? And then what's your bucket of your kind of carbon emissions that you just can't deliver on with current technologies or technologies that don't exist? And for us, that's really helpful as we think about, well, if we want to invest behind that company, we know what we're investing in terms of what they can currently do. We can take a view on when we think these projects are economic. And then actually, for us on our technology investing side, we can go, well, where do we find innovative companies who can help solve this problem? And when we can see the size of that problem across an industry, you go, well, that's a market worth developing technology and services business model for. Let's try and put some early stage capital behind that.
And how do you go about sort of evaluating that sort of roll the dice technologies when you're thinking about that?
Yeah, I mean, for the early investment, I guess what we look at is three things. One is a real market need. And that's where long-term transparency of need, either from governments giving strong signals or from corporates saying, this is a problem. I want to get to net zero. This is a problem I can't solve. I need help. Right? So it's long-term market need. Then, frankly, particularly for those early ones, quality of management team. And then an underlying technology that works. And so we put investment in a company called Carbon America in North America. They are doing two things. They're developing carbon capture and storage projects, but they also have a technology that can reduce by 75% the cost to sequester carbon from power plants. Early stage technology, but we think it's interesting. And if it if it works, it helps solve a lot of problem in terms of decarbonising traditional power and providing some of the firm power that we need alongside the more intermittent renewables.
And how easy is that to do without a sort of plausible carbon price? I mean, you talk about Canada. I mean, Canada don't think has a sort of a...
No, but that Carbon America operates in America, and there they actually have a long-term, clear carbon capture and storage incentive from the government, probably the leading one in the world. So if you look at highly concentrated sources of carbon, you can probably sequester those from $25 to $45 per tonne. If you go to all the way to direct air capture, where you're just capturing it from the atmosphere, that's kind of $300+ per tonne. The American government had given for every tonne of carbon dioxide that's sequestered, they'll pay $45 per tonne. They're talking about increasing that to 80, but that does mean that there is actually a viable market there that those companies can develop into. And as we've seen in solar and wind and other technologies, once you start investing and building up the scale of the industry, the costs can drop quite dramatically.
But you talked about government incentives and signals earlier there. Sorry, Nuwan, you want to come in?
Yeah, no, that's what I was about to pick up on. I guess, big question, it's sort of either, do you think the government and policies is doing enough here? We've got things like the UK Investment Bank, etc. There's opportunities to take first loss. There's lots of schemes where the government could assist, on top of planning. And we still seem sort of quite far away from being able to engage, wider sort of long-term money coming in to help fund these projects.
Can I just pick up on the transparency point, which I think is absolutely vital, and the disclosure of information, because otherwise how can you make decisions along your supply chain? So we have a number of potential opportunities to ensure businesses are disclosing the right information. We have the TCFD and particularly stress testing a business against future scenarios. So I don't want to use the word, the phrase crystal ball gazing, but we are, it's a methodology that enables you to look at a potential future, given a number of parameters, and then build a business strategy that enables you to deal with that. And as an investor, then understand the way that business is future-proofing itself. And I think, in the UK, the requirement to report against the TCFD framework is going to hit large lists of businesses from next month, from April of this year. But of course, it's not just the large list of businesses. It's an enormous raft of businesses from SMEs all the way up through the FTSE 250, to the really big companies, the big global players. And I think there we've got an opportunity to really understand how businesses are operating, but also how they are responding to the climate challenge. I mean, we know we have less than 8 years to reduce our carbon emissions by 50% globally. This is mind-bogglingly difficult. But if we don't have those disclosures, we actually haven't got a leg to stand on to get us there, because only by disclosing that information to everybody, publicly, to the infrastructure developers, to the investors, to the regulators, to the customers, to the shoppers, can we understand how a business is actually addressing the challenge of getting to net zero, and also demonstrating that it really understands climate change and the implications thereby. So I think your point of transparency is really the key to this. It's if we can support businesses and help businesses to understand the benefits of that, to enable them to grasp their own risks, to really understand what the risks of a changing climate are, to adapt and to mitigate. And the session earlier this afternoon referred to the most recent IPCC report, which is 3,500 pages of a terrifying future, which just boils down to the fact that we have even shorter time frame than we thought we had, and we have to cut our carbon emissions dramatically globally. And anything we can do to support businesses in doing that, because after all, businesses are the engines of our economies. Governments provide us with a different aspect of that, and of course we have to have public-private partnerships. We've had lots of sessions on that today, actually, in how the two have to come together, public money and private money. But actually, above all, we've got to understand what's happening, and we do that by transparency and by disclosure and by publicly allowing us to see that information and understand what the forward trajectory is.
I think you're right about the issue of transparency. Bill and Nuwan, I mean, what do you think about the level of transparency we have at the moment and how that could be improved, if it needs to be improved?
It definitely needs to be improved. The question is, how do you do it in an efficient way? Because we're asking companies, and to your point, this goes right down to SMEs, to report on things they haven't really reported on before, and that's a massive skill development across the industry, across the economy. I mean, the thing it kind of ties into the question you asked about the government action as well. I think the thing on the corporate being the engines, that's been the biggest positive for me over the last 12 to 18 months. It is the amount of companies making net zero commitments and starting to follow up with how do we deliver against those. And I increasingly see the enlightened, forward-thinking corporates being a bigger driver of unlocking the infrastructure development than the government. I think there's actually a lot of technologies that are proven, that are economically viable, where government just needs to help try and streamline the development of them so that we can just get to the scale that we needed, because to your point, Jane, we've got 8 years. But for actually some of the more innovative technologies, that's where I'm seeing actually partnership with corporates that need those new infrastructure rolled out to help them decarbonize is going to be better at unlocking that than government action.
Earlier when we were talking, you talked about this skills gap. I mean, that's sort of fundamentally important, isn't it, to find the right people to sort of do these jobs? I mean, how do we go about that?
Yeah, very much so. Look, I think, as Jane sort of spoke to, as we go through the sort of reporting cycle, it is, for many firms, the first time they've had to report on this. I think Jane quoted it might take them 3-4 times to get through, but, trying to recruit into that sector is definitely proving challenging. Getting the right skill sets in the right place, has not been easy. Now, we have 8,000 colleagues at Phoenix Group across the UK, and yet, we are finding it incredibly challenging. The growth in money into sustainability as a sector, globally. The skills required to deploy that capital, let alone monitor, then report on it. If you just literally multiply the number of people you need to be able to do that is a lot, very quickly. Education is the primary driver. So that starts with the board and governance and getting, and having companies sign up. But as we make these commitments, then we were also committing to educating all the way, across the group, if you like, or certainly across our group, in terms of having that skill set within the business and what does it mean. Because it doesn't obviously just impact our investing arm, it impacts the whole way through Phoenix Group.
Absolutely. Look, I'm mindful that we're running out of time. What I'd like to say is thank you, all three of you, for coming along today and talking about what is an extremely important and exciting subject. I know earlier we sort of discussed the fact that infrastructure may not be the most glamorous business, and I think that's sort of a mistake. First and foremost, if you've got children out there, obviously they should be retraining as sustainability gurus. That's one of the things we've learned today. But what I'd like to do is just finish up by saying thank you to our panelists, Jane, Bill and Nuwan. Thank you very much.